Welcome to Chart of the Day. I'm Nico Isaac. What's driving the housing downturn? Interest rates or investor psychology? Several key indicators in December confirmed a broad contraction in the housing sector, from the smallest rise in median existing home prices since February 2012 to a 4-year low in home builder confidence, and as this chart shows, a 10.3% decline in sales of existing homes, the biggest year-over-year drop since May of 2011. Mainstream analysts say central bank rate hikes are the biggest burden on housing sector growth. A January 9th Wall Street Journal article said the U.S. housing market is the canary in the interest rate coal mine and added this explanation, quote, "The funk in the housing market could be an important signal about the U.S. economy's sensitivity to rising interest rates. One important culprit appears to be the higher borrowing costs driven by the Federal Reserve's interest rate increases." End quote. Even so, something doesn't add up. Housing data began to show a slowdown in early 2018, yet the Fed had started raising rates much sooner. In fact, the housing market's canary sang a healthy song from 2015 through 2017, during which time the Fed hiked rates 5 times by 175 basis points. Mainstream housing prognosticators seemed unfazed by the hawkish turn in the Fed's rate policy. Only after home sales peaked in December 2017 and began to continuously fall did the Fed's 4 rate hikes in 2018 become the culprit. Now, imagine a different culprit looming in the housing market, which you knew was coming before sales and prices peaked. In fact, there was. In our June 2017 Elliott Wave financial forecast, we said rising interest rates were not the imminent threat to housing's uptrend. Instead, we warned subscribers about extreme over-optimism in investor psychology. Financial forecasts provided visual proof that, quote, "Participants and observers remain so optimistic that a recent Gallup survey shows sentiment more bullish now than at any time since 2005. That top was an early warning of the oncoming housing market collapse. Real estate is a prime candidate to become the next long-term investment trap." End quote. On its heels, our September 2017 financial forecast provided another piece of evidence of cracks in the housing sector's foundation, noting, quote, "The dramatic divergence between overall sales and sizzling prices in a select few cities reveals an underlying instability within the housing industry." End quote. In turn, home prices and sales peaked in December 2017. 1 month later, another critical indicator turned, as you can see in this chart of the U.S. home building sector's relative strength versus the S&P 500 index. This January 29 chart is the work of analyst Murray Gunn, and you could read his latest analysis today in Global Market Perspective. See below for more.